Pierre Daly, and we're at the Inside ETFs conference in Montreal. Today, we're talking with Pat Dunwoody, Executive Director of the Canadian ETF Association. Pat, thanks very much for joining us today.
Oh, thank you. Good morning.
Pat, why don't you tell us a little bit more about what your association does and what your role is at CETFA?
So the association was founded in late 2011 by three of the, at that time, 5 ETF providers in the industry because they wanted a voice. They didn't think there was a voice in the industry for ETF providers. I joined in 2012 and have been with them since, and really with sort of 3 pillars. One was the policy side, to make sure that if there was an issue, we could speak jointly. 2 was to have one common voice within the industry.
Right.
And the third one is all about education. We realized with the ETF providers, certainly when we started, we're quite small. With the narrow margins, they didn't have a huge marketing budget. They didn't have a lot of people that could go out and do the education. And what they discovered was not only did they have to speak about their product, they had to speak about ETFs first, and then introduce their products.
Right, to explain
what the product is in the industry. So what we do at CETFA is to do that neutrality of product information. So we have presentations, and I speak to a lot of advisors and firms, and in some cases investors, on what ETFs are and how they differ from other investment products, so that then when their advisor or the advisor wants to speak to them, that baseline is already set.
Was that, in sort of the earlier days of ETFs in Canada, was that a difficult, was the association created in order to overcome difficulties of entering into the wirehouses, the brokerage firms It's
funny. Our industry in Canada is very much a sold industry. Products are sold as opposed to bought. And the mutual fund industry in Canada is basically, the Goliath, and when we are the David. In the early days, the majority of the ETFs were probably bought. There's some institutional, but a lot of it were the do-it-yourselfers, right? So the self-directed organizations. To try to get into the other brokerage arms was a difficult push, because not only did you have to sell them on the product, the advisor basically had to shift their clients into a fee-based account. So we had to take a step back about a year and a half ago and take stock of that, and realize that as much as we want to talk product and how valuable the product would be for a lot of clients, we had to figure out how to get advisors to understand that some, or not all, certainly not all, but which clients should be flipped into a fee-based account without even talking product. So let's flip into fee-based accounts for X. So then the question came, well, what clients do I move to fee-based? Yeah. And then the discussion got into the risk. So how do you look at your client base and know that which clients are at risk of potentially leaving or going to another advisor? So there's a long runway of considerations that the advisor has to do long before they look at ETFs. It may be an add-on reason for a client to flip to a fee-based account, because not only does the structure differ and the fee payment of the fee differ, but now they've got 700 more products that they can look at. Right. But it's a long process to get them there.
So is it safe to say that the Canadian ETF Association has played a substantial role from day one?
Because we are a central point of contact for a lot of editors and newspapers, I think over the last few years, the number of magazines and newspaper inserts and articles on ETFs has grown dramatically, because it's an easier process for those firms to do. They come to me, we organize the advertisers and the articles, and they produce it. So it's getting to the point now where I think clients are asking their advisors about ETFs, not specific products, but what are these things? Right. And that then opens the door for the conversation.
And it's been remarkable how rapidly the industry has been growing here.
I think the percentage growth, because we're starting at such a small base, the percentage growth is dramatic. We're still sort of the country cousin to the mutual fund industry, but I think people are starting to take notice now. And as the mutual fund companies introduce ETFs. That sort of introduces a whole new form of marketing for the industry, and as the banks do it as well, because as more firms enter the market and there are more people out there, the entire industry is going to be successful, right? So as the tide goes up, all the boats go up.
Yeah, the competition is incredible to see. I think because of the so-called sort of democratization of financial securities through ETFs, commoditization of indexing.
Yes,
it's really we see a real sort of very high competitiveness to differentiate. It's a very healthy, very robust marketplace that's developing for advisors. There's also a strong need to be able to explain to advisors when they need it of what all that differentiation is and how much is it actually different, and how much of the differentiation is let's say spin, and how much of it is actual differentiation.
Absolutely. I mean, for the last few years, I think there were a lot of companies out talking about smart beta.
Right.
And to the point where they didn't think at different events you needed to have smart beta panel because everybody understood it. Let's move on. And one of the index providers, FTSE Russell, did a survey in the U.S., Canada, and in Britain on smart beta through the advice channel, and it was very clear that there was still not a lot of, I mean, the knowledge, they understood the concept of smart beta, but it was really, the knowledge base was still very low. So that was healthy for us to see, so at least our members were able then to pick up their old PowerPoints and go back out and to start explaining, because what we've done a lot is in our seminars, and we reach out to the universities as well, but to show the different components of the industry. So yes, you may understand what an ETF is and how it trades, but let's start at square one, and do you understand what an ETF or an index provider is, and what their value proposition is, and what is different between Index A and Index B, so that you understand that piece, and then you can move on to the product creation, and then you get into the trading elements, because those three components are hugely important and I think quite often overlooked.
And now, of course, we have the entrance of active ETFs, which has been also very interesting, and it's a dimension that exists in Canada more so than elsewhere. In a way, it makes the ETF space a little more exciting, because it brings an element of investing to ETFs that wasn't there before. And how has that been for you in terms of integrating it into your work?
Well, the numbers of active ETFs is substantive. That's where the growth has been over the last year and a half.
Right. Assets
are still slow to move into that, because they're a bit of a more difficult story to tell advisors. What we think it makes it easier for those current active mutual fund companies to launch product, because that's what they know.
It's not a diversion from what they've done always.
And they've been preaching active management, so for them to flip to index wouldn't be appropriate. So that in itself may help the active side, just because the advisors understand active mutual funds, therefore it's just a different wrapper and the same product in essence, so it makes sense for them. But we know the world is watching, just because we are sort of one of the larger countries that's introducing the products.
Once you indoctrinate the idea of ETFs and passive investing or low-cost investing into the hearts and minds of advisors, and then that transpires to investors, have you found or have you heard from them that marketing has been difficult beyond just marketing these simple concepts? It kind of made the narrative for advisors talking to their clients a little less exciting at times, or a little less stimulating, because it came down to data, and it came down to...
I think what you see, and certainly because of the performance in the last few years, or 5 to 10 years, is you can actually show the returns where fees actually make a difference.
Right.
And granted, at the all-in fee process, we're not saying that we're next to nothing, because there's still a point or point and a half that the advisor gets for their management, but it's outside of the actual return of the product. So even when you add in the commission or the charges for the advisor, the products are so inexpensive, it's still substantively less expensive for a client to hold those. And it makes an absolute difference on their overall return. An absolute difference. It also, I think, outside of the fees, I think a lot of them are easier to understand. So you can tell a client that here's the index, here's what's in it, this is why, even on a factor-based, because you can explain it fairly easily. And a client then can actually follow it, right? If you're in an S&P 500 index product, you open the paper and you can see it. So at a high level, you know exactly every day what your product is, your investment is doing. Yeah. Whereas with an active manager, by the time there's a good return on a fund, a mutual fund, and people pour their money into it, it's on its way down. Whereas with an index, you can look at it, and if you understand a segment of an industry, or a piece of an industry, or a country, you can target your investment to just that, knowing if you're an expert in a certain area, that's where you should be in. We've also got the luxury I think overall it's to the benefit of investors.
Absolutely. If a lot of the so-called closet indexing that has happened historically gets done away with, and the assets find a better home.
It's interesting because the whole active-passive discussion, we have a report that we put on our website. It's just a big spreadsheet that has all the ETFs in the industry and various data elements tied to each one. And one of the columns used to be active-passive. And we had a group looking at how do we get to that next level of, so if it's passive, but if, is it always passive? If it's active, how active is it? Mm-hmm. So we were looking at that next level down.
Right.
And after a year and a half of discussion, we took away those two titles, and we now say index tracking, non-index tracking. Because that's basically
it. So it becomes more specific.
It's very specific. So you can track an index but still be active, because you may be factor-based, so you're juggling, but you're still tracking an index. So it's much easier then for an advisor to explain that to a client. And if it's active, then it's going to be pure active. But then when you're trying to build a full diversified portfolio, it's much cleaner to look at those two component pieces.
Much easier for investors also to understand.
Absolutely.
Finally, Pat, yesterday there was an announcement from the Canadian Securities Administrators about compensation. I was wondering if you had any comment on that.
Really, the big piece is that they want to get rid of DSC and low sales charge. So that doesn't impact our industry at all because we didn't have that. We have, there were some companies out there that offered trailer fees. Most of them have made the announcement, if they haven't already gotten rid of those products, the advisor class, they are in the process of. I think First Trust is the only one that's staying with some products, but they were never as popular as with mutual funds. I guess what will be a positive potentially for the ETF side is if those companies and advisors and clients now have to look at other products because they're shifting or other business models.
Right.
If they do shift then from a DSC model to a fee-based model, ETFs become a logical addition to their product list, which is great for us.
Pat, it's great to meet you, and it's great to see you at the Inside ETFs conference.
Thank you for having me.